How's it going, guys? Welcome back to another video. Today I brought you a website which is called Roark AI, which is a website to analyze the company's fundamentals and everything. So basically we're gonna learn how to use accounting principles to analyze stocks like a pro, okay? Or at least like above average person, or at least know what you're doing a little bit. So understanding financial health of a company through its accounting data is going to give you a significant edge in the market, okay? Or at least help you a little bit, helping you make more informed in strategic investment decisions within it's which you need to do if you want to start investing, especially when it comes to stocks or any investment that has volatility. Okay, so I'm going to try to break it down a little bit, and just keep that in mind that I'm not a pro. I am just an enthusiast, and I'm here just here sharing a little bit of my experience with you guys and a little bit of my knowledge. So that being said, let's go ahead and start. And another disclosure, that's not financial advice by any means. This is just educational purpose, okay? So the first step is the revenue or sales, okay? So the first thing you need to look up to is the company's revenue. And I'm talking about Apple here. So this company is like super well established in the market, but it serves for Apple and pretty much every company that you want to invest. So the revenue, the company's revenue, which represents the total sales a company generates. So consistent revenue growth over time is a strong indicator that the company is expanding its market presence or launching successful product, okay? In this case, with Apple here, I don't even have to say anything about Apple, you know what I'm saying? So if the revenue here is declining, it's a red flag that requires further investigation. So you got to take a look on that, okay? Now, step 2 will be net income or the profit. Okay, so the next step is net income, which is essentially what is left after all expenses, taxes, costs that have been subtracted from the revenue, and so on and so forth. Okay, so a growing net income suggests that the company is not only generating more sales but also managing its expenses effectively. Okay, so basically this is a key indicator of a company's profitability. So take that into consideration as well. Okay. So you can see a little bit of that. You can see a little bit of that right here. Okay, so the sales, revenue, turnover, gross profit, operating income, loss, pre-tax income, everything from 2009 all the way up to now to 2023 using Apple, for example. You can see the last 15 years here, last 30 years, annual, quarterly, pretty much everything with this website right here. Okay, so step 3 is profit margin. Okay, so profit margin are another crucial metric to consider. You need to take that into consideration. So gross profit margin, like I said, showing here, okay, or operating margin and net profit margin, profit margin. Each of them tell you different things about the company's financial health. Okay, so high margins generally mean that the company has strong pricing power and it is effective at controlling costs, which is especially important in competitive industry. So the higher the margin, technically saying the better, but that's just one factor. Like you need to take every single thing into consideration. Okay, so it's like you're building a puzzle here. You need all the pieces of the puzzle, kind of. So basically, the other step is debt levels. Okay, so debt to EBI TDA ratio. Okay, so understanding a company's debt is vital for assessing its risk. So the common metric is debt to EBI TDA ratio. Okay, which compares the company's total debt to its earnings before interest, taxes, depreciation, and everything, and amortization as well. So the lower ratio is generally better, because usually that indicates that a company is not overly burdened by debt, making it more resilient through economic times. So through a recession or some crisis or something like this, okay? So the next step is liquidity. So liquidity, it measures a company's ability to meet its short-term obligations. Okay, so metrics like current ratio and quick ratio will give you an insight into whether a company has enough assets that can quickly be converted to cash if needed. Okay, in worst case scenarios, then you need to make sure the company that you're investing into has at least a little bit of liquidity in a worst case scenario. So high liquidity suggests that the company is on solid financial footing and can weather short-term financial challenges, okay, just in case that happens, which could happen to pretty much everyone. okay, because no one's immune to that. So the next step is return on equity, or ROE. Okay, so basically return on equity, or ROE, is a measure of how efficient a company is using shareholders' equity to generate profit. So basically, a high ROE indicates that the company is effectively using investment capital to grow its business, which is a positive sign for the investors. Okay, and you can check all of it in ROIC.ai. Now the step 7, okay, we're almost finishing, guys, is free cash flow. So we're going to talk about free cash flow. So basically the cash that is left after the company paid all the operating expenses and capital expenditure. So that's kind of what it is, okay? This is crucial here because it shows how much cash the company has available to return to cash holders, to the shareholders, which is us. Okay, reinvest in the business, or pay down debt. Okay, so the more the free cash flow they have, the better for us as shareholders, because they pay us with this free cash flow. Okay, and that's pretty much it. Okay, so these are one of the key steps that you need for using accounting to analyze a company's stock. So by understanding these metrics, you'll be able to be equipped with more knowledge and skill to make smarter investment decisions. So whether you're looking to build a diversified portfolio or focus on specific high potential stocks, but make sure that you add everything into the equation. Okay, add all the steps that I told you. Make sure you have to take into consideration also your life. So what are you going to do? Are you going to build a portfolio or not? Or are you just going to hold one company or multiple companies in your portfolio? How much of that company you want to have? What is the percentage of it? Are you more aggressive or more conservative? Do you want to have more liquidity or not? Do you have a cash flow just in case you need to use money for a emergency, for example? So there are a million things that I could talk about when it comes to investing, and this is just the beginning. Okay, so that is one way that you can analyze your stocks and how are you gonna invest your money. Okay, so I root up for you. I hope you can accomplish all of your dreams, or at least get some extra income from using stocks or building your portfolio and understanding the risks of the market. Okay, so that's pretty much it for the video. Thank you so much. I'm sorry about stuttering. I'm sorry about sometimes I make up a mistake here or there. I mispronounce a word or something because of the English barrier, but it is what it is. I am trying to get better, and I hope you can understand at least the core idea of the video. And I hope this video was insightful for you, and I'll see you on the next one. Bye. Thank you.